Let's go back a few years to the 2008 financial crisis and Great Recession. You might have been in junior high, high school, or college during this time. You might have been just starting out your career or thinking about starting a family with a loved one. That fateful year changed everything. Within months, people were losing their jobs in droves, which forced many people to downsize or even go homeless. Millions lost their retirement savings, homes, and other assets. Is it coming back to you now? Those sleepless nights where you wondered if this was the end of everything. Maybe you saw the stress on your parents' face, but you couldn't pinpoint why. Well, a lack of preparedness and overconfidence in the market played a big role in the stress. Let's discuss the signs of a floundering economy and what you can do to navigate the waters in uncertain times. How the economy works. First of all, we need to understand why recessions happen. The economy runs on a cycle. First, we have a period of expansion, where the economy experiences a period of growth. During these times, interest rates are low to encourage lending and investments. Other indicators of the growth phase include increasing wages, corporate profits and output, and the supply of goods and services. Money flows more freely around the economy, given the low interest rates for lending. The flip side is that inflation can creep up during this phase. Phase 2 is called the peak. This is a time where growth hits a maximum rate. Prices for goods and services, profits, wages, and other indicators don't grow anymore and hit a period of stabilization. As businesses see the peak, they may adjust their budgets to reflect the lack of new growth in the economy. Governments may also act to rein in runaway inflation by increasing interest rates for lending. When governments and businesses start to readjust, we come to phase 3, which is the contraction or correction phase. In these times, growth slows or even stops. Unemployment may rise with an increase in layoffs, and wages become stagnant. With fewer people working, there is less demand for goods and services, which leads to an oversaturated market with a surplus supply and a decrease in prices. This phase, if not controlled properly, can spiral out of control and move from a recession to a depression. Finally, when the recession or depression hits rock bottom, we enter the final phase of the economic cycle, called the trough. This phase is when both supply and demand are at their lowest levels. The economy at this point is struggling with stagnant spending and income, with individuals finding ways to make ends meet. Businesses also are reconfiguring their budgets in an anticipation of an economic recovery. Governments may also reduce interest rates to encourage businesses to borrow more money and to invest. Signs of a worsening economy. While we can't predict when things may go south, we can look for signs that indicate that the economy is weakening. If you see these signs, it may be wise for you to look into your portfolio and to start making changes to combat significant losses. Worsening unemployment rate. When the unemployment rate goes up, it means that fewer people are working. With fewer people working, fewer people can buy things such as cars, electronics, clothes, food, etc. When fewer people can afford such things, demand decreases, leading to a reduction in price, and the spiral continues. Rising inflation. Now, inflation isn't all that bad. An uptick in inflation can signal a higher demand for goods and services due to increased wage growth and a stable workforce. That said, if inflation gets too high, people will be discouraged from spending money, reducing demand on goods and services. Reduction in property sales. With both inflation and employment rates going in the wrong directions, it can have serious effects on property sales. With fewer people buying homes, it can create, once again, a glut of supply, reducing demand. Increasing debt defaults. With fewer people working, that means that they cannot afford to keep up with their debt payments. As more people start defaulting on their debts, more people go bankrupt, resulting in a spiraling effect in the economy. As you can see, these 4 indicators, when combined together, create the perfect storm for an economic disaster. Lower employment means fewer people making money, leading to less demand for goods, services, and property, and more people defaulting on their debts, leading to even more unemployment. Pretty easy to see how this can fall apart in a hurry, right? How to protect your wealth. Now that I've scared you into thinking that we're all doomed in an economic depression, let's turn things around and discuss ways that you can protect your wealth during economic downturns. Diversify. This isn't anything new, so I won't go too deep into this. Ever heard of the phrase, "don't put your eggs into one basket"? Well, this is basically it. Instead of having investments in one mutual fund, stock, or bond, it's wise to diversify your investments. It's possible that not all asset classes will lose money in a depression. It's also good to diversify to mitigate guaranteed losses. If you have a pool of stocks that overall dropped 30% in a 6-month span during a recession, it's better than having one stock lose 50% in the same period. Wouldn't you agree? Emergency fund. We don't know if we'll lose our job during the next recession. We won't know how long we'll be out of work. In times of famine, it's important to have an emergency fund saved up to help cover essential expenses. Most financial experts agree that having 3 to 6 months of savings is a good threshold to aim for. Debt management. Carrying debt during economic downturns is simply too much stress to have. In times of plenty, be sure to pay down your debt as quickly as possible, saving up much needed cash flow during times of famine. The last thing you want to think about is how to cover your credit card bill and pay for your groceries at the same time when your income, or lack thereof, can only cover one of those items. Save yourself the stress and pay down your debt as soon as you can. Review investment strategy. If you find yourself sweating at night over your investments, it may be wise to reevaluate yourself, your goals, and your risk tolerances. It might be time to think about whether or not you can handle a 50% drop in your portfolio in a 6-month period. If you're unsure on how to go about this, I highly recommend speaking to a financial planner or advisor about your investing strategy and what would be the best fit for you given your circumstances. Dollar cost averaging. You might find that you have the risk tolerance to stomach large drops in prices of assets. You might even think that it's a great time to buy, which it very well could be. One great way to take advantage of different price points in stocks is through dollar cost averaging. How it works is that you take a particular investment and you buy into it at a regular fixed interval. That way, you can take advantage of lower prices during the recession and reap the benefits when the investment increases in value, regardless of when you bought in. Staying calm and informed. Staying calm during economic disaster is no easy feat. That said, if you're positioned well, have a strong emergency fund to rely on, have steady income, and little to no debt, you will weather the recessionary storms with ease. It could be beneficial for you to stay informed about the economy and markets. Research reputable sources for information on how the economy is doing, and be ready to profit when the economy recovers. Do your best to avoid making irrational or impulsive decisions, whether it's a large purchase, investment strategy, or career-related. Talk to a trusted advisor for guidance, and bounce ideas off those that are of sound mind. One final thing. You might want to look into creating passive income with your investments. I have an entire video on how to do just that with dividend stocks. Be sure to check it out in the left corner. Thanks for watching, and I'll see you next time.